In this video, we're going to start working on the notes that are titled Using the CAPM. We're going to be looking at the capital asset pricing model from the perspective of it being a one-factor asset pricing model. We've already said that it is a theoretical asset pricing model. Now we're going to look at it as a one-factor model, and that's going to be important because later on we're going to be looking at multi-factor models that have two or three or more factors. The one factor in the capital asset pricing model is the market risk premium, but getting ahead of myself here. So I'm going to pull up the notes, okay, for this section and put it here. And so we're going to see, we're going to start out with this equation right here, okay? And it says the return, this is not expected return, but the actual return on stock I is equal to its expected return plus M sub I plus E sub I. What is M sub I? M sub I is the impact of unanticipated macroeconomic events, things that affect the entire economy that were not expected. What is E sub I? The impact of unanticipated firm-specific events, things that impact this individual company that was not expected. Now, the expected, let's think about that in context of this formula. It says the actual return for a stock is equal to its expected return plus the impact of things that weren't expected. And we're saying there are two categories of things that were not expected, things that impact the entire economy. And of course, this firm is part of the economy, so it gets impacted through that. And things that impacted just this stock, but didn't impact the entire economy, like a good earnings report or a bad earnings report, something like that. A recession or inflation or an increase in gross domestic product, things like that will affect the entire economy. So the firm does get affected. That's the M sub I. Now, it's important to understand that the expected value of the unexpected is zero. The expected value of the unexpected is zero. If something is truly unexpected, we don't know whether it will be good or whether it will be bad. If it's more likely to be good, then we have that as part of our expectation. See, this expected return on stock I incorporates everything that we know about the economy, everything we know about the stock, everything is already incorporated into that expected value. But there will truly be some information comes out that we didn't expect. I mean, that happens all the time. Okay, that's what news is. It's something that comes out that we did not necessarily anticipate. It could be that we were expecting some good news and the news was even better. So the unexpected component of that is how much it was better than what we expected. Or maybe we were expecting something bad and it turned out to be worse. Then the unexpected component is how much worse it was than expected. So what determines the actual return on a stock is, first of all, what was expected, the expected return, which we've already spent some time talking about with the capital asset pricing model, plus the impact of things that were not expected on the economy and the impact of things that were not expected on the firm. So the expected value of M sub I is zero, but we know that just means it's equally likely to end up being a positive as it is a negative. And the expected value of E sub I is also zero. Now, different firms are going to have different sensitivities to macroeconomic events. We're going to go through an example in a little bit. So F is going to be the macroeconomic factor. It's going to be the unexpected change in the fact something happens in the economy. That's going to be captured by F. Each stock has a different sensitivity to that. So the change in the economy affects every stock, but it affects them all differently. Beta sub I is going to be the sensitivity of the firm to that factor. Now, this is not the same beta not exactly the same beta we were talking about in the CAPM. So now just think of this beta as being the sensitivity to the factor. So M sub I is going to be beta sub I times F. The impact of the factor times the sensitivity to the factor ends up being the impact to the firm of the macroeconomic event. Let's go through an example. I think that'll help things out a little bit. Let's suppose you wake up tomorrow morning and you hear that oil prices have unexpectedly gone up by $10 a barrel overnight. Okay, so tomorrow morning you wake up, oil prices you didn't expect this have gone up by $10 a barrel. That is a macroeconomic factor. It affects everybody. It doesn't affect everybody the same, as we will see, but it affects the entire economy. Suppose you are the CEO of ExxonMobil and you hear this news that oil has gone up by $10 a barrel. Well, this is a great way to start your day because ExxonMobil owns a lot of oil. So if the price of oil goes up by $10 a barrel, they are thrilled with that. So the beta to this factor for ExxonMobil is going to be a positive number, a strong positive number, so that the impact, M sub I, is going to be positive, and therefore the return increases. So the factor is an increase in the price of oil. ExxonMobil's sensitivity to that factor is positive, meaning that the impact to ExxonMobil is going to be positive. So if M sub I is positive, that means the return is going to go up for ExxonMobil. And that makes sense in that situation. But now suppose you are the chief executive officer of United Airlines, and you wake up and you hear that oil has gone up by $10 a barrel unexpectedly. This is not such a good news for you because you use a lot of oil. So it's the exact same factor. Oil has gone up by $10 a barrel, but your sensitivity to it, your firm's sensitivity to it, is a negative sensitivity. That when oil goes up, that's bad news for you because your costs are going up, and as a result, you have a negative impact. So for United Airlines, it's the exact same F, but it's a different beta. It's a negative sensitivity. So that means M sub I is going to be negative, and that's going to cause the returns for United Airlines then to go down. Finally, suppose you are the CEO of Microsoft, and you wake up and you hear that the price of oil has gone up by $10 a barrel. And you say, gee whiz, we don't own oil. We don't really use much oil. It doesn't really have any effect on us. Your sensitivity is something close to zero. So even though the factor is the same, the price of oil went up for everybody, your sensitivity is close to zero. So its impact on you, M sub I, is going to be something close to zero. Right? So we can see the same factor had increase in the price of oil is going to have different sensitivities to all three of those firms. So the beta is going to be your sensitivity to this. Well, we can think of lots of factors in the economy that will have an impact on firms' returns, right? But we want to come up with a very simple model that only has one factor. You might think, what is the one factor that really encapsulates all the other factors? Okay, all the other factors are part of it. And that one factor is going to be the excess return on the market, or let's just say right now, the return on the market. Is the market up or is the market down? If the market is up, what causes the market to go up? Well, news about the price of oil causes the market to go up. News about gross domestic product, news about the economy, news about what's going on in trade talks. Everything impacts the market. So the question then becomes, okay, well, if you can have your money in two places, the market and in the risk-free asset, when is it that you wish you had your money in the market? When the return on the market is greater than the risk-free rate. So to get some scope to this, we're going to make our one factor not just the return on the market, but the excess return on the market. The excess return on the market is going to be R sub M, return on the market, minus the risk-free rate. See, if the risk-free rate is at 3% and the market's up by 2%, that doesn't mean, wow, the market did great, you should have had your money in the market. It means, no, you still wish you had your money in the risk-free asset. So, but if the risk-free rate is at 3% and the market's up by 6%, now the market is up and you wish you had your money there, and the market is having a positive impact there. So in our simple one-factor model, The one factor is going to be the excess return on the market. So we want to see for all the firms out there, what are their sensitivities to that factor? Okay, like we're looking at right here, we want to, the factor we've now identified, the F is going to be the excess return on the market. So we want to find for each firm, what is their sensitivity to that factor? Now, just like we said we needed to get a scale for whether the market was up very much or not by comparing it to the risk-free rate, we need to do the same thing for individual firms. So we're not looking at whether the return for the firm is up or whether it is down, but is it up by more than the market, or is it up by less than the market, or down when the market, I'm sorry, is it up by more than the risk-free rate, or does it go up by not as much as the risk-free rate? So just as with the factor, it was the return on the market, it's the excess return on the market, the return on the market minus the risk-free rate. We want to look at the return on the stock as being the excess return on the stock, the return on the stock minus the risk-free rate. So we want to see what is the stock's sensitivity to the factor. And this is going to be the direction we're going to go with this. And we're going to be doing it in the form of a linear regression, okay, which we've talked a little bit about. So a linear regression is always going to be of this format right here. You're going to have your Y variable on the left. And in this case, our Y variable is the excess return on stock I. And remember, stock I is just any old generic stock. The excess return means it's the return on stock I minus the risk-free rate. That's going to be equal to alpha. Alpha is going to be our Y-intercept on our regression, plus the beta. That's the sensitivity of our stock to the factor. And the factor is going to be the excess return on the market. The beta is also going to be the slope of the regression line as well, plus E sub I. Now, E sub I is an error term that we have here. That just means that we're going to have residuals, that not everything is going to fit right on the regression line every single time. Okay, so but the E sub I ends up averaging out to be 0. It's also your impact of unanticipated firm-specific events, which on average are going to be 0. Sometimes they'll be positive, sometimes they're negative, but on average they're going to end up being 0 there. So how do we go about, how are we going to go about doing this? Well, what we want to do is we want to go back and take a look at what has been the stock's sensitivity to this factor in the past in order to forecast what we believe it will be in the future. Now, just like we've talked about before, okay, we cannot know a stock's beta with certainty. The reason we can't know it is because it's not constant over time, for one thing. What its beta was in the past is not necessarily going to be what it is in the future. And what we're really interested in is what is it going to be in the future. We can measure what the beta was in the past. Then we have to ask ourselves a very good question. Do I think the beta that I'm really interested in, its future beta, is going to be higher, lower, or the same as what it was in the past? We'll talk more about this later. But for right now, let's just find out what the stock's beta was in the recent past by going back with 5 years of monthly data to be able to calculate this. So we're not going to do it yet, but we're going to do a regression where our Y variable will be the excess return on the stock. Our X variable is going to be the excess return on the market. We call this a univariate regression. We call it a univariate regression because there's only one X variable, which is the excess return on the market. Now, it's important to understand that in all regressions, there are certain assumptions. And unfortunately, some of these assumptions are violated in our regression. But that's the way life works in the real world, right? And here's our assumptions 1 through 4, that the relationship between the dependent variable, that's the Y variable, and the independent variable is constant over time, that unless we are using the entire population of returns, our sample, and we're only going to use 5 years worth of returns, our sample will give us a point estimate of alpha and beta. And then we're going to confidence goals for their true understand that because we pass, we're not looking at all time, we are not finding the true sensitivity to this factor, the true beta for this stock. What we're finding is an estimate of the beta. And then we can say, we've got an estimate. How realistic is this estimate? If the estimate is this point, could it be way up here? Could it be way down there? Or could it only be like right here and right there? We're going to get into that, is what our standard errors are going to tell us. Another assumption is that there's a linear relationship, straight line relationship between the dependent and independent variables, and that these residual values are uncorrelated, meaning that everything else other than the market is not correlated with each other. Now, that's not a very realistic assumption either, but that's what we are making when we use linear regressions here. So what we're going to need to do is go back over the last 5 years and find out what was the excess return on the stock, what was the excess return on the market. Now, we've already seen how to go into Yahoo Finance and find out what the returns on a stock were for the last 5 years using monthly data, and the returns on our proxy for the market, the S&P 500. To get excess returns, we need to know what was the risk-free rate each month for the last 5 years. And we have to subtract that from the returns on the market. And we subtract it from the returns on the risk-free rate. Now, here, we can do this, and it's a good idea to do that, okay? However, it's not going to give us much of a difference in terms of our final estimate of beta. In fact, if the risk-free rate was unchanged during the last 5 years, you're going to get the exact same estimate of beta by using excess returns versus using the absolute returns, meaning just as the return on the market and the return on the on stock I. So what we're going to do is we're going to take the easy way out on this. We're going to use the return on stock I, and we're going to use the return on the market, and we're not going to subtract the risk-free rate. I want to say that it is better to subtract out the risk-free rates, but you have to have the data to be able to do that. Actually, I'm going to show you where you can get the data, okay? But we're not going to go through those steps and subtract out the risk-free rate. We're going to take the easy way out to calculate the beta of the stock, which is just regressing the absolute returns on the stock and the absolute returns on the market. So we're going to talk a little bit more about that in the next video.